And so we can structure a 20-year installment note from Steve's trust back to Harry, or Harry's trust, Harry's revocable trust, and use today's 1.9% long-term rate. Good Lord. It's the lowest that we've ever seen it. And that results using level amortization and an annual payment back to Harry, $720,000 a year, which is not taxable to Harry, because the trust that he created is what we call a grantor trust. He's going to pay the income tax on all the income that's allocated to that trust, which is a further way of transferring assets out of your estate. But if you move all 990 out of 1,000 shares to Steve's trust, you better have other assets to pay that income tax. So this is going to help him pay the income tax. But if it's not enough, what do? We can put in tax reimbursement clauses in these trusts and other things. But we want these trusts to be respected for income and estate tax purposes. And so we have to be careful about how much we set aside for the kids. So I've got a couple of clients who are operating very successful government contracting firms. We're rushing to do these transactions right now. As soon as I get done here, I have to go back and finish drafting the documents, where we're going to transfer 10% of their companies into trusts for their kids. That's enough that they can manage right now. Can they do more in the future? Yeah, but without valuation discount. Okay. So the loan to value ratio, the IRS informally has said they like to see at least 10%. That's why it's $1.2 million based on a $12 million loan. And security for the note is important. Question?
Are you guys using any balloon payment options? And using that as a leverage to do instead of larger discounts?
Yeah, I don't like using a balloon on a 20-year note, because it starts smelling and looking like equity, and that's a potential challenge. Is it an enforceable loan?
Okay. So
can you do it? Yes, you can, but I'd like to stay under 10 years maturity on that. And so we have done 9-year maturities using the applicable midterm rate, and the rate's even lower than 1.9%, with interest only and a balloon at the end of the 9 years. And what happens if you can't pay it off at the end of the 9 years? I'm sorry?
If you can't pay off the loan, do you recognize that?
Not necessarily. If you can't pay off the loan, you could actually transfer shares back in payment, or you could modify the loan and extend it. But would you extend it at the low rate of interest that you entered into today, or at the future rate of interest at the time of the extension? Or would you provide additional security? It's what a commercial bank would do, and that's really what you're looking at. You're trying to structure it very carefully so that it's enforceable, and at least enforceable in the eyes of a banking lawyer. So we usually have we usually consult with our lawyers if we're going to be modifying, one of our banking lawyers, if we're going to modify or extend the loan, instead of just doing it, or we pay the shares back, but we'd have to get a valuation at that time to take the shares back.
Because I was going through that now, and that was one of the issues, because I was reading there's some code that was saying that it could cause you to, I guess, have to do some exemptions if you can't pay off the loan. You can modify to an extent, but I was reading that it could actually cause a bad debt. Because I'm a government contractor, the concern would be is that you do it now and the business doesn't grow, and then you can't pay off the loan in the future.
I've had that happen before, and what we've done is we've taken the shares back.
Okay.
Because it's not unwinding the transaction, it's saying I have the right to pay it back with anything, with cash, with any kind of property. But you have to basically determine the value of what you're getting back. So as long as you can determine the value of what you're getting back and it's fair market value, then that's okay. But that's not the only way to do it. So a loan modification, providing personal guarantees, something that might bolster the validity of the arrangement is always recommended. So this is a picture of it, but Harry's basically selling the LLC units to Steve's trust, taking back a 20-year note here, and he's also putting a gift into Steve's trust so that there's a seed gift there, so that the trust has substance apart from its ownership of the stock. The outcome is that Harry retains control, which is beautiful. I've seen it work backwards for the beneficiaries where they think they're getting something and at the end the owner just pulls the plug and takes back control of the business and kicks out the beneficiary from the business. So Steve could be without a job even though he owns through a trust 990 shares of the company. I've seen that happen. So caution for the beneficiaries. Income tax reporting is a little bit more complex because if it's a dynasty trust and it's a grantor trust and Harry owns the voting stock, he also is treated as the owner for income tax purposes of the dynasty trust. The LLC is technically a disregarded entity for tax purposes, right? Because Harry's deemed to own 100% of the income of the LLC. So there's special filing requirements for that, for the trust and for the LLC. It's not as complex though as filing a partnership tax return. How does Steve's trust make the note payments? Hopefully there's enough cash being thrown off from the business for him to do that. And if there's not, then we get into questions like Carl's asking, what do we do? How do we pay back this note? So structuring at the front end is really important. Understanding what the value of the asset is, what its cash flow generation capability is, really important. When Harry dies, the unpaid balance of the note will be included in his estate. It may trigger income tax recognition on the unpaid portion. That's the downside, as well as the value of the note. But if the note's sufficiently far into the future, it might be discounted substantially. So we bring in the appraisers again. But Steve's and Dottie's and Mark's trusts are all exempt from estate tax and generation skipping transfer tax. And we've created a vehicle to have wealth flow down now and not necessarily be subject to claims of creditors. So if they don't have the right to withdraw the assets and there's an independent third-party creditor managing a $10 million trust in each case, in Steve's case it may be even bigger, 20 million, 30 million, then there's lots of assets to manage and there's lots of assets to take care of the beneficiaries and their progeny. And then, of course, Steve will end up acquiring control if they've remained friends throughout this whole process. So the discount generated $3.8 million in estate tax savings, plus any tax on the appreciation and value of the company. If the company remained level, it's not as good of a tax plan. But the valuation discount generates a huge benefit. If you've got companies that are doing this, if you've got clients that are companies that are growing, this is a great technique even without the valuation discount. That's just the lesson that's being learned here. So 2704, we're planning with an expected effective date of 12/31. Comments are due by December 1, then the IRS technically has 30 days to act on the comments. That's the end of the year, it's during the holidays, but the IRS has issued final regulations on December 25th and December 26th and December 20th. I've seen it happen, so it's possible they may actually go final by the end of the year. And so we're not taking any chances with our clients. We're saying, get it done now. To get it done, you have to have an appraiser enlisted, and they are busy now. They're all busy. Anybody here an appraiser? Okay. That's because they don't have any time to be here. They're too busy. This 3-year rule is problematic. Again, my natural inclination is to say don't worry about it, but we can't say that. We don't know that for a fact. Clearly, if you enter into a transaction after the regs are final and you die within 3 years of that, it's going to be brought back into your state. The valuation discounts, there will be no valuation discounts. There will be no special treatment. If you do it before the end of the year and then die within 3 years, and the regs go final in that time period, we don't know what's going to happen yet. We hope that they'll grandfather all transactions prior to the final regs going effective. But another important point is this one. We can still get discounts on transfers of undivided interests in other properties. So if we have a piece of real estate and we really need the discount, you might get a tenancy in common discount, 25%, 20 to 25%. That is not covered by the 2704 rules. Gifts of interests to cuprates are not covered by these rules. So it's only entities. You're giving an interest in the entity. Stock, membership interest, partnership interest. We don't know if they're only going to be going after active trades or businesses, only investment vehicles. So you set up an LLC to own marketable securities. That clearly is captured by these rules. I think the intent of the statute when it was enacted was to exempt active trades or businesses. So if you have a government contractor or you have something else that's an active trade or business, investment manager or whatever, you should logically qualify for an exception for these rules for transfers of minority interests. But there's no indication in the regulations of that. And so they're broader than what the legislative intent was when this law was enacted.